Well, hello everyone. This is Brent Stransky here with my friend Zach Miner. It's September 19th. It's a Tuesday, and we're here with Financial Footnotes. Zach, how are you? What's going on?
Everything's good, man. Everything's good on the East Coast. Beautiful day outside. Got a
It's
little
been great here,
Fed meeting in progress. See what Jay does.
Jay. That's his street name.
I'm on a first name. I'm on a first name basis with Jay.
That's not even his first name. It's like his initial. It's nice to be so tight with the Fed chief. So, what I wanted to share a couple of things with us today. I'm going to talk a little bit about where we are. I want to talk about investor sentiment, one of my favorite themes. Sorry to belabor that, but I think it's important. And finally, I want to finish on that Fed meeting, which I agree with you is happening right now. So a lot of the data that I'm going to show today is actually from the previous meeting, but a lot happening as we speak. Zach, what are you going to be talking about today?
I got a couple things I found interesting, kind of changing the changing structure of the market. See where we are with the Fed cycle. A little bit about China. A little bit about interest rates.
It's going to be an exciting day. I can barely wait. So, without any ado, let's get started. So, the first chart I have for us here is taken right from the Wall Street Journal this morning. This is just looking at markets, right? I want to take a step back. Where are we? What's happened in the last 3 months? And the answer is basically nothing. What we're seeing here is the three major indexes. It's been pretty slow over the last 3 months. Since the beginning of the summer. So we've kind of been range bound. We talked about this last time we were together, Zach. We talked about the 65-day moving average, and you intelligently discerned that this was in fact maybe 3 days of trading data. But this would be created kind of like a technical boundary here for the market that's kind of providing some baseline here for us. So that was my first note, that stocks have been flat for at least 3 months. And as we talked about last time, we're still 7% below the S&P 500's all-time trading high, which was placed almost 21 months ago. What are your thoughts, Zach?
Yeah, we've just been in this kind of consolidation, range-bound area for the last couple months, and it's not surprising after having such a kind of volatile, violent 18 months. A lot of downside volatility in 2022, a lot of upside volatility early part of 2023. So it's not surprising to just take a pause and consolidate here, where I think we're at that inflection point of what the Fed is going to do and what inflation is going to do, and I don't think anyone's really sure of whether we're done or not, or whether there's more to go. So it makes sense that we're kind of at a pause here. And it's also been a pretty generally quiet time in the market. August is usually pretty low volume.
Typically summer, pretty slow. Folks are at the beach in their Hamptons mansions. Not me and you. We're in the trenches. We're still making the work happen. So I just want to take a step back, just 30,000 foot view of the markets where we are. It's been a slow summer. Doesn't necessarily feel that way based on the news cycle, as you pointed out. I want to turn to investor sentiment. It's one of my favorite themes. We're going to come back to it time and time again. We talked about it last time. So this next chart I actually have is from AAII, American Association of Individual Investors. We're going to look at it again and again as time goes on. It's a free website. We're not affiliated with it, but it's something you can go out there and check yourself if you wanted to. And this is investor sentiment. This is not to be confused with consumer sentiment or business sentiment. And Zach, something so exciting. I came to my office today and look what I got. Have you ever gotten one of these? This is from the Census Bureau. I've never gotten one of these. I'm so excited. So the Census Bureau is asking yours truly for his opinion on sentiment, right? This is business sentiment. So I can't wait to log in and report back how. Very cool. I thought it was from the IRS. I was very concerned.
Never got one of those. Never been called for jury duty either. So I don't know. Maybe
You seem like such an upstanding citizen. I can't believe I'd want you judging me if it came down to it. Hope it never does. So coming back to investor sentiment here, you can see that this particular chart I'm showing you as of last week, this is a weekly chart, and about 34% bullish. It's been about in that same trend line for the last 4 weeks, near the historical average, which is also on this chart of about 38%. And you can see that the last 12-month high is about 51%, and the bearish high was about 61%. That was an extreme high set almost exactly a year ago. So moving on, the next chart, which is a new chart. I'm very excited. Maybe Zach, maybe even you haven't seen this, but this is the bull bear spread, which is simply subtracting the bearish sentiment from the bullish sentiment. And the point I'm making here, net bullishness, if you'll allow me to use that fabricated term. It's been decreasing since the late spring, but is generally more positive since a year ago. But I did want to quickly advance to the next slide. And this is continuing the theme of investor sentiment. This is kind of taking half a turn more towards institutional sentiment, I suppose, with kind of the put call ratio. We've talked about this before. I do think it's a good indicator of kind of short to midterm sentiment in the marketplace. This is showing you that the green line there, it has been climbing since July and August. There was apathy in the marketplace. People were not buying a lot of protection. This chart is showing you how many people are putting the money down to buy protection on their investments. And you can see, it took a big decline here since last January when people were seeking a lot of protection. There was a lot of pessimism in the marketplace at that time, and would have been a good time to invest. Any thoughts on that particular indicator, Zach? I know you asked about it before, but
yeah, definitely. We've had typically, especially with the kind of the bull bear spread and a lot of these sentiment indicators are oftentimes contra indicators, but it doesn't necessarily have to be a reversal of what's happening. It can indicate just a consolidation, and the indicators can recycle without it necessarily declining or rising. I think that's kind of what we've seen, especially with the bull bear spread, where it's come down since kind of the exuberance of the spring, and the market's been down a bit, but it hasn't been down meaningfully. So I think you can kind of recycle these indicators, without having to have a significant move one way or the other. So that's kind of what's been happening. And if you look, at that first investor sentiment chart, we're basically on trend, on just historical average, kind of a neutral position, which could be also construed as complacency. Not much conviction one way or the other. Everyone's just kind of waiting to see what happens. So that does kind of make you think that there's maybe not as much offsides one way or the other, which
totally agree. And I think that is a great setup for my next chart. Thank you for looking ahead and giving me this great setup. And I think your point's great. Not always are we going to look at this data and be compelled one way or the other. But when we spoke last time, we talked about some data that came out about last year, because last year there was extreme pessimism, right? And so this last chart I have on sentiment is just data that LPL, our broker dealer, published last May. And it looks complicated, but just bear with me. Since 1988, 35 years of data, the AAII has published data, and only 31 times has sentiment been less than 20% of constituents were bullish, thinking the markets. So that's extreme pessimism. And to your point, Zach, this doesn't happen very often. And then as of that time, which was over a year ago, the next 6 and 12 months look particularly good for the S&P 500, with a mean return of 21% over that time. Pretty amazing. So it does show you that when people,
and it's not 30 or 31 anymore, right? Because those last 4 data points down at the bottom were all positive, right? And significantly so. So now it's 34 out of 35. Now
yeah. And this
the present day, because this was a year ago. Yeah.
This is why you and I are out there. I think one of the core things I'm trying to share with you all watching at home is there's a couple of indicators that we can watch. I think, this is a good one. It's not always, nothing is ever explicit, right? But it's a good way to read the tea leaves. What are people thinking? And it's a great way for us to try to manage expectations over the mid and short term. So any other thoughts on that, my friend?
Yeah, it's interesting when you have these big extremes on one way or the other. That does tend to portend a large market move, right? Volatility to increase when folks are off sides, and you start to get FOMO when it starts to move against you. And so right now we don't really have that. It's a fairly neutral positioning. Protection put orders are starting to increase, but it's not at an elevated level. Sentiment's pretty neutral. We're at a consolidation 10% below 10% or so below the all-time highs. So it doesn't feel to me like there's big moves, right coming around the corner, because so much neutral positioning.
I think that's a great point, my friend. So we'll leave it at that. I'm going to move on to the second point I wanted to make today, turning our attention to the big meeting happening with your friend Jay, my friend Jerome, Maybe one day I'll get there. So I want to talk about interest rates. This is the tail that's wagging the dog. We've talked about it before. I think it has a huge impact, and you're going to talk about later, my friend, but a huge impact on all manners of the economy: interest rates, credit cards, car loans, home, etc. So this first chart I have here is I think pretty cool. Just a couple of notes on it. It's from the Wall Street Journal today, and it's showing you the last 6 interest rate cycle increases. And the point I'm making, the top one, which was started last year in 2022, you can see two things. One, it was faster than any other of the previous 5 cycles over the last 35 years. And secondly, it's already longer in duration than 3 of those 5. What do you think, Zach?
It's when I see this, it makes me think that it would be very hard to believe that we would get through that with no economic pain whatsoever. That we would just coast right through. There would be no repercussions of the fastest and highest rate hiking cycle of the last 50 years, or 40, 45 years since Volcker in the 70s. I just don't see that being a realistic expectation. Now, the extent of which the damage will be done is certainly up for debate, but the market and kind of a lot of talking heads are starting to really talk about no landing, right, or a very soft landing, and I just find it a little bit difficult to believe that we'd be able to raise borrowing costs this
And
much.
what Zach is telling you, the viewing audience, what Zach is saying is something that is a golden standard for our financial footnotes podcast here. If everyone's saying something, we ought to be thinking about the opposite as a possibility of occurring. So I think, you're right. I mean, what Zach is also alluding to is that when the interest rates were rose in the early, 2006 and 7 cycle, that was helped exacerbate the great financial crisis. So, these are seismic activities here that may be lost in the minutia. So something we definitely want to highlight.
One point on that, that 2000, early 2000s, interest rate hike cycle, is that there were a lot more adjustable mortgages in the market back then.
Mm.
I don't have the exact numbers in front of me right now, but I know it's low single-digit percentages of overall total mortgages in the U.S. right now are adjustable.
Great point. Second point I'd build on top of that is that, the largest financial institutions have, passed more rigorous stress testing from the Federal Reserve Bank. So in a better position than they were possibly ever. So I think that's part of the reason, but always looking under the hood here to see if there's some other shoe to drop. So great point. Moving on to the next chart, the Federal Reserve is going to tell us tomorrow on Wednesday, the 20th, what's going to happen with interest rates. You'll already know by the time you're watching this podcast. What is the Federal Reserve coming up against? Well, on the next chart, I'm showing you that they've had some great success on the core and overall inflation rate coming down significantly. But one thing I'm seeing in the news, and I know you are too, my friend, crude oil prices, right? Everyone's talking about crude oil prices up significantly. But what I love about this particular chart is it's showing you that even in the beginning of last year, oil was well over $100 a barrel. So that crashed down earlier this year, and that helped reduce overall inflation, not core inflation, which tracks out energy prices for you at home. I guess this is kind of what the Fed is probably worried about, maybe increasing energy prices, influencing consumers' opinion of what's going to happen going forward.
Yeah, and I'm hoping that the Federal Reserve Board and their teams of economists are looking through these numbers, and I'm sure that they are.
I'm sure they are.
A higher oil price tends to slow down the economy, which is kind of what they want. So it could be, yes, the overall inflation is ticking up primarily because of oil prices, but that should actually be a kind of a drag on other areas of the economy, which should be good for core inflation, right? So you kind of look through that and say, like, hey, there's kind of a pinhole that they could drive through here where oil prices are up, not so much so that it kind of kills economic activity, but it does slow things down a little bit, which would be kind of good for their mandate. So it is interesting, and there's folks like Jamie Dimon out there who are taking a kind of a different view, and he's said in the last couple of weeks that he wouldn't be surprised to see oil in the mid 100s per barrel and interest rates above 5%. So there's folks who think that that's not the case, but
yeah, Jamie Dimon being the CEO of JP Morgan Bank, the largest financial institution in the country. which we're not affiliated with. But I also wanted to share that, listen, crude oil, the market is the most manipulated market in the world. There's a lot of pricing pressures coming in and production cuts to stimulate price by the OPEC nations and others. So I think that economists could probably agree that the natural price of oil is somewhere well below 100, and then it's the manipulation of that price that is changing it going forward, always complicating the Federal Reserve's job. But that's what we're paying them for. So that brings me to my last slide, which is the most complicated looking slide. The dot plot, yes, my friend. So just looking at, I heard this really great quote. This is one of the few commentators actually pay for their advice, Jared Dillian, and he said this in last week that since the 1970s, the Fed has never had a rate hike that was at its peak for more than 9 months, meaning that we're probably looking at a decrease going forward. Now, it could be a speed bump, such as a financial hiccup, or worse, as you mentioned a moment ago. But what this chart confusingly shows you is that, the best guess of the smartest people and the decision makers, the Federal Reserve voting members, what their expectation is, this year, next year, 2025, and then, the quote unquote longer term. And you can see that there's an arc downwards. I think we're probably looking, according to the decision makers, at a 1% or more lower interest rate in the next 12 to 24 months. So I think that could be a tailwind for the markets. It typically is historically. But I think despite some unknown, like you mentioned earlier.
Yeah, I think this is going to be the kind of the big story for tomorrow. They're not going to raise interest rates. I think the chance is like less than 1%. So they're not going to raise rates tomorrow, but they are going to release new dot plots. And
I'm excited.
This is I think what's going to move the markets. And I would not be surprised if these dots trended a little higher over the 2024-2025.
They have to,
period.
yeah.
Because I think that it's just the data is just not there to really support, a drastic change in their posture, both because of positive economic news and kind of negative-ish inflation news, right? Kind of both of those things are not really indicating that there's going to be a cut, right? So that could probably be a negative for the markets for the rest of the week, I would think. If they do kind of raise these dot plots to say that, hey, that 2024 cuts may not be in play, and then even another raise right in December. And I think the market's pricing in about a 50-50 chance of another raise in December.
Well, we'll have to find out. We'll have to wait until tomorrow. All right, my friend. Well, that's all the prepared comments I had for you today. What do you want to talk about?
So my first one here is I want to zoom way out. And yeah, I saw this chart on Twitter, and I just thought it was really interesting. When we make a lot of historical comparisons. Looking back at trends back into the 60s and the 70s and the 80s, and everyone kind of lionizes the Warren Buffett school of thought and thinking about how he's thought about markets and building his portfolio over the years. And I think it's important to recognize that the market is completely different than it was in the 60s, 70s, and 80s. And the major difference is the fact that most companies, not most, but almost half of the companies on the stock exchanges are not profitable now. Whereas in 1960, less than 5% of the companies that were publicly traded were not profitable. Most of them had very positive profit margins. Another chunk had positive profit margins, and only a select few companies were kind of categorized as high growth companies that were not earning a profit yet. And you kind of fast forward into the 2020s, where 40% plus of companies total on the stock exchange have no profits. So it's just a very different market. It's a very different way of analyzing what type of companies are, and coincidentally, a lot of those companies are the ones that are doing the best, right? That do not actually make any money. So I just think that when you're reading a lot of those old books, and when you're analyzing trends and market trends and correlations between indicators, you just have to take into that account that there's really a very different set of companies that make up the market as we call it. So I thought this was
That's
really
a great point. I feel like in our lives, and you'll you can probably agree with this, but it seems to me like there's, the modern markets, which they refer to as post World War II. So a lot of data goes back to 1945. But,
Right.
to this point, like what's the value? It's a completely different market. Maybe a better indicator is something like the 80s or the 90s. What do you think?
Yeah, and I try to really like I look at those types of indicators, those longer run indicators, but I kind of try to stay away from them really prior to the year 2000. And you talk about uh, what's changed in the market, and there's the obvious ones. The flow of information, the internet, the access to all of this information at our fingertips. That's obvious. But you don't necessarily think about something like this, where just the character of the companies themselves has really drastically changed. And I don't think a lot of investors necessarily realize that. And I think it's important to know when you're making those historical comparisons.
Great point.
And so we'll come back down to earth a little bit. This one kind of just piggybacks off of your dot plots and that quote up there. Just looking at what the time is after the final Fed hike for yields to start going down, and to your point, it's generally pretty quick. And within 18 months, and this is from 1995 to 2018, the average decline in 3-month T-bills after in the months following the final Fed hike, and 18 months later, those T-bills were down 2.5%. T-bill
Great
yields.
chart.
So I think that's right, and I think what that means for today's current situation is that rates will be higher for longer because I don't see a cut really coming in the next 3 quarters, right? And if you take this at face value, this kind of says like there's a cut within a quarter, or two max, right? There's going to be some sort of cut, and I just don't see a cut happening by March of 2024. I just don't see there being a situation outside of some black swan banking collapse that just comes out of nowhere that we just don't see. I really just don't see that happening. So in my mind, that means that those dot plots, those few Fed governors that have that, towards the top of that little pattern there, are the ones that are going to end up being right for much of 2024, and that rates are going to kind of stay sticky up there.
Great chart. Maybe the most important chart of the day. We'll have to see.
And then so moving on a little bit to what could potentially cause that cut, right? Like, what are those things out there that could cause it? And certainly economic weakness is the thing. And I think what the Fed is trying to do is not only tamp down inflation, but give themselves back that ammunition that they haven't had in order to counteract economic weakness. When rates are at zero, you can't cut anymore to stimulate the economy. So I think that they've been trying to get to a position where they can cut again, but not back to zero if they need to stimulate the economy. So if we get to 5.5%, 6% on a Fed funds rate, they can cut it to 3, still be, at their kind of near their terminal rate, but having cut by 3%. Right. So, and if you only get to 3, then, and you have to cut 3, well, now you're back to 0 and you're in the same conundrum that you were in for the last 10 years, which I don't think that they want to be in. So I think part of that is why they've gone so fast is so that they can give themselves the ammunition, but remain above their kind of terminal rate target. And so
Got to keep that powder dry.
got to keep the power dry. And so one thing you have seen is that the 4-week moving average of U.S. bankruptcy filings has kind of shot up. And so you're starting to see some cracks in those less profitable venture-backed companies that just don't have the ability to refinance or raise money. They're running out of cash and starting to declare bankruptcies
So this is corporate bankruptcy.
corporate bankruptcies, companies more than 50 million in liabilities. So not small companies. These are
Yeah.
relatively large-ish, not mom and pops, right? Not your Main Street companies. So, but it's interesting because high yield spreads haven't really started moving at all. So you kind of have there's a lag there, I suppose. But this is, I mean, we're looking at GFC levels of moving average bankruptcies, right? I mean, this was a big spike so far in the last couple months has really taken off.
But
So,
but as I'm looking at the y-axis here, it looks like it is, a handful, right? It looks like even at this spike, you're talking about 8 a week. Is that what we're seeing?
yeah. Not Yeah, a handful of the total, but it's kind of just illustrates a trend, and you start to
Moving
think
in the
through,
wrong direction.
you think through like what could cause the Fed to actually cut, and it would be economic weakness that comes in, um, you know, faster or more of a larger magnitude than was expected. And so I think that that's something to definitely keep an eye on, because if you're pricing in a cut in early 2024, that's the only way it's going to happen, right? They're not going to do it just because let's say inflation magically goes back to 2.5% tomorrow, which it's not going to, or 2%. Even if that happens, they still wouldn't cut in the next 2 quarters, right? They wouldn't do it. They're going to hold it there for a year at least, until they are sure that inflation is done, barring any economic weakness. So the only way you're going to get a cut in the early to mid 2024 is with some sort of significant economic weakness. So that that's what's kind of being priced in, which that's the only way that happens, which is
Interesting.
interesting. So I'm going to jump a little bit to overseas here, and for much of my career, probably the whole thing, it's kind of been a foregone conclusion that China's economy would eventually overtake the U.S., and it was seen as inevitable. I think that there's cracks starting to form in that narrative. I don't know if it is inevitable anymore. There's been significant slowdowns in the Chinese economy, and as we saw with COVID, I think COVID, what it did is showed companies that their supply lines and their sourcing of materials is perhaps more flexible than they may have thought, and it kind of forced them into some positions of rejiggering supply lines and changing some things, and it kind of showed them that it was possible to pivot away from China, to just not be so reliant on China. And so this chart's just showing is that I bet you wouldn't have guessed that in 2023, Mexico as a percent of total U.S. imports was more than China, right?
Incredible.
12-month moving average. And other countries are on the rise as well, especially in the Asian Pacific region, Vietnam, Korea, and
Interesting how that happens just before my time, which is just before your time getting into this market, getting into this business. There was another country that was going to surpass the U.S. in total GDP, and of course, it didn't happen. That was Japan, but that was the fear, that was the headlines at the time, and it's a very similar story to China. People were very afraid of that back in the early '90s.
There were whole college courses taught on the rise of Japan, and
There were pop songs written about learning Japanese. It was
definitely the in vogue idea in the 80s, that it was a foregone conclusion, right? Japan just does everything better, and then Japan's stock market doesn't do anything for 30 years,
30
and now
long years.
the idea of them being a bigger economy than the U.S. is it's not even
No one's
possible.
saying it. It's you can't find it.
So I just think that the same thing is kind of happening with China a little bit, and you kind of look at that next chart of just their the real GDP growth history, and it's just kind of fallen off a cliff. And I think that what we've been able to see is that there's been too much kind of government intervention, and while that is certainly effective in the short term for propping up industries, right? They don't have a true free market. They've tried to kind of blend capitalism and communism, and enable the government to come in and prop up industries and prop up the currency and prop up companies, and not really have true price discovery. But what that eventually will do is catch up to you, because you can't do that forever, and they're seeing it in their property markets right now, with ghost cities, whole cities worth of skyscrapers that have nobody in them. You can only keep doing that for so long, right? And I think what you're kind of starting to see is that the free market is starting to win out a little bit, coupled with the fact that they are, enhancing their aggressive posture towards U.S. companies and U.S. interests, and you throw in the COVID supply chain changes, and all of a sudden you have some significant decoupling from China and the U.S. And I just think it's an interesting kind of change in narrative, because it was always just assumed that it was going to happen.
That it was. that it was. Well, yeah, great charts today, I think, all around.
I got one
I
more. I got one more for us.
Oh,
Um,
okay. That must have been a late edition that didn't make it to
well,
my
maybe it is. Maybe it is. So this last one is just kind of looking at the stock returns annualized versus the treasury returns annualized. Um, Going back to 1970 and the four different stages of the business cycle: early expansion, mid expansion, late expansion, recession, and looking at what is the most likely regime are we in, right? Are we in early expansion? Probably not. Are we in mid expansion? I guess maybe we could be, but I think more likely we're in late expansion or potentially entering a recession still. Right? There's a lot of those indicators that are still just screaming recession. And I know it's been the most talked about, most predicted recession ever. That doesn't mean it's not going to happen. It just means it hasn't happened yet. And if you kind of look at that differential, in the late expansion period, stock returns annualized are 8%, treasury returns annualized 7%. Not that much delta for taking equity risk when you can get 6-7% treasuries. And then obviously in recession, there's a 35% delta between the two. So I just think when you're thinking about asset allocation and how you're allocated between stocks and bonds, looking at this which regime are we in, where in the cycle are we, I think can inform your decisions, especially when you're talking to more conservative folks in retirement that are taking income. There is an alternative now, right? You can earn 5, 6, 7% in very safe fixed income securities.
And from the 30,000-foot level, I guess in some ways it's surprising that equities haven't declined further, right? There
Definitely.
are certainly a lot of net positive flows to bond markets and cash over longer periods over the last 12 months because interest rates are so attractive. So it's in one way, maybe it speaks to the strength of the underlying variables within the market itself.
It does. I mean, it's been confounding how strong the economy and the market has been, with all of the headwinds that are there. It's been very surprising that the market has kind of held up and the economy has held up. The unemployment rate has held up as strongly as it has. We did look at it last week though. Those those 2024, 2025 earnings estimates. The high bars to jump over. That we'll have to clear in order to make these multiples make sense.
We'll have to wait and see. But I think one point, just to kind of bring it home here, we talked early on in the conversation about sentiment, right? And if we look back a year ago, 9 months ago, right, market was down at the end of last year. It was at its trough maybe about a year ago, just around the time that sentiment and the AAII survey was also at a trough. So I think we can take another note there that as everyone, including pundits, are saying the market's doing terrible, it's maybe an opportune time to observe the market is already putting a bottom in. And I think what we're seeing now is a lot of market commentators, a lot of Wall Street economists having to readjust their year-end expectations upward to compensate for the mistakes that they made.
Definitely. Good talk.
All right, my friend. Well, it was great talking with you. Hopefully we can do it again here in a couple of weeks. And everyone, thanks for joining Finance and Footnotes. We will keep you posted. Bye.